Good afternoon, everyone. Welcome back to Filter Coffee with Quantace. I am Karthick Jonagadla, and today's episode we are set to explore a mix of compelling dynamics in the markets. We'll discuss the current market overview, delve into the recent challenges faced by Kotak Mahindra Bank following RBI's regulatory actions, and wrap up with an insightful discussion on thematic risk in investment portfolios. So grab your coffee and let's get started. Let's delve deep into the current shaping or market landscape today. In recent sessions, we have observed a notable trend among FIIs, a robust continuation of rolling over their long positions from the previous expiry. This activity reinforces our view that an intermediate bottom firmly established at 22,000 levels on Nifty remains pivotal marker in our market's structural integrity. Peering into the options market, we see clear signals. The first robust line of defense for Nifty stands at 22,600, backed by a secondary safeguard at 22,400. These levels are not arbitrary, they are informed by a combination of historical data, current market sentiment, and quantitative analysis, serving as critical thresholds that could dictate the short to medium term market trajectory. Turning our gaze to broader events, we have two significant developments that investors must monitor closely. Firstly, the Federal Reserve's FOMC meeting is on the horizon. The outcome of this meeting are anticipated with bated breath as they hold the potential to sway global market sentiments, especially in terms of monetary policy adjustment and interest rate forecasts. Simultaneously, domestically, the Lok Sabha elections are underway, a fundamental democratic event that traditionally influences market mood through political stability and policy expectations. Another catalyst, smaller yet significant, is the upcoming financial results from Kotak Mahindra Bank. Given its substantial weight in both Bank Nifty and Nifty index, any shift caused by these results could ripple across the market. This is particularly pertinent considering the recent regulatory restrictions imposed on Kotak by the RBI, which could influence investor perceptions and the bank's operational dynamics. On the macroeconomic front, we have witnessed a record-breaking milestone in GST collections, which surged to an unprecedented 2.1 lakh crore in April 2024, marking a 12.6% increase. This isn't just a number, it's a testament to robust consumption patterns across India, with rural areas showing particularly strong activity. This trend indicates a narrowing consumption gap between rural and urban areas, suggesting a broad-based economic activity and an expanding consumer base, which could drive investment opportunities. In terms of our investment strategy, we maintain our preference for micro cap, small cap, and mid caps over large caps for the forthcoming 4 to 5 weeks. This strategy has been recommended by us since the starting of April 2024, consistently aligning with our analysis, which supports this pecking order based on growth potential and current dynamics. Currently, our focus sectors include manufacturing, metals, real estate, mobility, and pharmaceuticals. However, anticipate shifts here as we approach our next rebalance. We are continuously scanning the horizon for emerging opportunities and will update our sector focus based on the latest market conditions and our forward-looking analysis after tomorrow's rebalance. Now let's pivot to a significant development in banking sector that has caught the eye of investors and market analysts alike. The recent RBI restrictions on Kotak Mahindra Bank. The situation provides a perfect lens through which to examine the complex interplay between regulatory actions and financial market dynamics. Firstly, let's discuss the financial metrics that have been directly impacted. A critical one here is the CASA ratio, or the current account to saving account ratio. Given which has seen a substantial decline of 13% from its peak, now hovering around 48%. Why does this matter? The CASA ratio is pivotal because it indicates the bank's cost of funds and its overall financial stability. A lower CASA ratio implies higher cost of funds, which can squeeze the bank's profit margins. Moving to the credit card segment, which despite accounting for only 4% of Kotak's total loan book, plays a crucial role due to its profitability. This segment has seen a growth of 21% year on year in new customer acquisitions and a 34% increase in spending. The high return on assets from this segment means that any stalling year could significantly impact the bank's overall profitability. Regarding the bank's valuation, it has seen a noticeable dip. Kotak's market valuation now has fallen below that of Axis Bank, which stands at rupees 3.4 lakh crore. This shift in valuation reflects the broader concerns that the market has regarding Kotak's future growth trajectory due to RBI's restrictions. Kotak has been heavily reliant on digital channels for customer acquisition. This strategy, while innovative, becomes a double-edged sword under the current restrictions, especially given Kotak's comparatively smaller physical branch network against giants like HDFC and ICICI Bank. Looking at a comparative scenario, let's consider HDFC Bank's experience in 2020, which faced similar regulatory challenges. The restrictions were eventually lifted after HDFC demonstrated satisfactory remedial actions. This precedent offers a potential roadmap for Kotak's recovery, although Kotak's smaller network could mean its path to monetization might face stiffer challenges in the longer term. The regulatory overhang and the recent shifts in management could delay any potential re-rating of Kotak stocks. Investors will need to stay vigilant, monitoring how the bank adjusts its governance structures and responds to these regulatory changes. Lastly, the opportunity cost associated with these developments are significant. Kotak's ability to capitalize on the growing demand for unsecured lending products like credit cards may be constrained, limiting revenue streams that were expected to be key contributors to its profit margins. To sum up, Kotak Mahindra Bank's current problems underlines the impact of regulatory actions. As we round out today's episodes, let's tackle an often overlooked but crucial aspect of investing: thematic risk. Understanding this concept is vital for anyone looking to build a resilient and balanced investments. Thematic risk occurs when an investor's portfolio becomes too concentrated in stocks that are all related to a particular theme. For example, if you have a heavy allocation towards banking stocks, your investment performance becomes highly sensitive to the health and the regulatory environment of the banking sector. This type of concentration means that when significant market events affect the banking sector, whether those are regulatory changes, economic shifts, or other sector-specific news, all your banking stocks are likely to react in a similar fashion. Positive news which might boost your entire investments, but adverse news can just as easily cause significant losses. So, how do you manage this risk? The first step is diversification. It is one of the foundational principles of investing. By spreading your investments across various sectors and themes, you reduce the likelihood that a single event will impact your entire portfolio. Diversification isn't just about having different stocks, it's about ensuring these stocks operate in different sectors, are driven by different economic factors, and have varying sensitivities to market changes. This way, you are not putting all your eggs in one basket, so to speak. Another crucial, critical strategy is regular investment reviews. This involves periodically checking your investments to ensure it remains aligned with your risk tolerance and investment goals. It's also a chance to rebalance if any one theme has grown to dominate your investments, inadvertently increasing your risk exposure. Let's illustrate with an example. Imagine your portfolio initially as a mix of tech, healthcare, and banking. Over time, if banking stocks perform exceptionally well, they might come to represent a much larger slice of your investments than intended. Without realizing, you have become highly exposed to banking sector's fortunes. Regular reviews and rebalancing would correct this drift, realigning your portfolio and your intended risk exposure. Implementing these strategies helps protect against thematic risk, ensuring that your investments are not only diversified but also truly reflect your long-term financial goals. Remember, in investing, managing risk is just as important as seeking returns. This discussion about thematic risk wraps up our in-depth look at banking sector and broader market trends today. It's crucial for every investor to understand these concepts to navigate the complexities of market effectively. Thank you for joining us for another episode of Filter Coffee with Quantace. If you found this segment enlightening, please like and subscribe for more such videos. Share your thoughts or questions in the comments below. And let's continue this conversation. Until next time, keep diversifying, keep reviewing, and keep your investment smart.